Welcome to Fridays with Vistage. Today's webinar title is How You Calculate Business Value and Why It Matters. I'm your moderator, Bill Black, host of the Exit Coach radio show and a Vistage member and speaker. And today we're focusing on maximizing the value of your business. When the time comes to exit, of course, you want to get maximum value, but do you truly know where the value resides? Have you received conflicting advice from your accountant, lawyer, and banker? If a competitor expressed interest, would you know if their offer is reasonable? Well, in this webinar, Dave Heymann, Senior M&A Advisor at Generational Group, will discuss where true value resides in a business that will one day be sold. Dave will examine myths surrounding business value, how recasting can change business value, and he will discuss an example to show how buyers calculate value. Dave's diverse business background spans almost 40 years and includes all aspects of professional deal-making. In the first half of his career, Dave participated in numerous middle-market acquisitions, working directly with sellers both pre- and post-sale. In later years, Dave worked on the sell side of M&A, helping sellers prepare for and execute transactions. Ladies and gentlemen, Dave Heymann.
Thank you, Bill. I really appreciate it. Welcome, everyone. I'm going to try to make sure and get everything covered in less than 45 minutes because we've received a lot of questions in advance, and I'm sure we'll get some others. And so I'm going to try to get things done in less than 45 minutes. We'll jump right in. The topic of business value was too big to cover in one 45-minute webinar, and so we've divided it into two pieces. Today we're going to cover how buyers calculate value. And then on April 26th, we'll cover what are the major factors that drive value up and, of course, drive value down. So for today, we'll focus on what is the correct process to follow. We'll talk a lot about formulas and multiples for determining value, which most of us have heard about. We'll examine what is it the buyer's really buying, because that's where true value lies. And then we'll finish with a demonstration, an actual example of how professional buyers calculate value. So let's start with making sure we're all understanding the correct process for selling a business, which also therefore devolves to the correct process for determining value. First, a business owner has to decide to sell the business. That's the first step. Why is this person selling his or her business today? They could have sold it 5 years ago or could have waited and sold it 5 years from now. Typically, people pick the time to exit their business when there's something else that they want to do. They want to start another company, become a consultant, play golf, buy a boat. If the seller decides today is the day to sell his or her business, the first thing they've got to do is determine an asking price, a get-out number. The first thing the buyer is going to ask them is, what do you want for the business? So we have to determine what we think the business is worth. Then we have to go find the buyer. The only time we can avoid this is sometimes the buyer has already approached the seller, but most of the time a business owner will decide to sell his or her business without the buyer having been identified. And so we're going to go find the buyer. Typically, we will focus on finding a buyer that is at least familiar with our industry, if not our specific company. And so we'll focus on competitors, customers, suppliers, employees, family members, anybody who's got a background in the business. Once we tell the buyer the asking price we want for our company, they're going to say, well, you need to show me some evidence that it's worth that much money. So if we haven't already done so, we must collect documents that describe the business's history, obviously financial documents, but also brochures and history statements. When we present all of that information to the buyer, now they've got a picture of our business's past. A period of negotiating will ensue. To keep this short, I'm taking things like letter of intent and due diligence, and I'm just calling that negotiate. And then, assuming there's a fit, we'll sign our name and get paid. Before I go any further, ask yourself, is this the process that you expected? Is this the process that you would use? I can tell you right now, this is definitely the process almost every seller used during my career, but it's not the process they should have used. This is the broker process. And what I mean by that, if my regular lawyer or my regular accountant sells a company, they were actually trained to follow this process. However, an M&A lawyer, somebody whose entire firm only buys or sells companies, they were trained to follow the professional process that I'll show you in a moment. A business broker is a licensed real estate broker, but they don't sell homes, they sell businesses. And typically they will sell like to like. They'll sell trucking companies to trucking buyers and software companies to software buyers. I'm not suggesting one method or another is better or worse. They each serve their purpose. But when it comes to value, the maximum value is derived from following the professional process. This is what all investment bankers, all true M&A professionals, all M&A lawyers follow. It's not just companies like Generational. There's lots of other professional investment banks, and everyone has always followed this process. In the interest of time, I'm going to briefly show a few steps from the professional process and show you how they differ from the broker process. First of all, we start not with a decision to sell. That's got to be the last step of the process. If you're selling your business for the maximum stack of dollars, for the big stack of dollars, you can't decide to sell your company until you know what you're going to get paid, how you're going to get paid, when you're going to get paid. So not only do we need to not decide to sell to the end, as far as the second step of the broker process, determining price, in the second webinar, we'll talk about how the right type of buyer versus the wrong type of buyer dramatically affects value. We'll talk about optimal buyers. Optimal buyers tend to have the resources and the risk tolerance not only to acquire the company, but to do something with the company that the seller was never going to do. As a buyer, most sellers didn't realize this, but if your business is going to be worth more to my board than it is to you, what good would it do for you to give me a number? And so, although I rarely had to do it because sellers didn't make me do it, I always knew when I'm an optimal buyer, I'm supposed to give the seller's numbers, not the other way around. So in place of those two steps, I'll give you two different steps: evaluation and decision. Notice I said evaluation. I make that point because most people are familiar with the concept of valuation. Valuation is done for partner buyout purposes, for divorce purposes, for exit planning, succession planning, tax planning purposes. Evaluation, it's only for mergers and acquisitions purposes. What's the difference between the two? If I asked you to tell me the value of Apple computer stock, would you give me the same response as if I had asked you to tell me to evaluate Apple Computer as a potential investment? Of course not. One is about the past, one is about the future. The next step is to make a decision, but it's still not the decision to sell the company. That's still the last step. The way the professional process is developed, along the way, we have to make lots of choices as to how to proceed, but deciding to sell is still the last step. Under the broker process, I intentionally wrote the third and fourth item in the wrong order. Almost everyone is going to collect documents and then find the buyer, but I felt justified writing them that way because under the broker process, they are independent steps. It doesn't matter which one you execute first and which one you execute second. Under the professional process, you have to reverse the order because one step depends on the other. We'll talk in a few minutes. Most people assume what they're selling is their business, but all of my years buying companies, your business was never what I was pitching to my board. So it does you no good to try to sell to me something different that I'm turning around and selling to my board of directors. So the documents will represent the opportunity that I'm selling. You'll see this in a moment. And then, of course, we do have to find a buyer, but professionals want a prospecting pool. I won't spend a lot of time on this because the second webinar will talk about buyers, but a prospecting pool will typically have 200 to 400 buyers in it. If you're thinking, I don't know, two people want to buy my business, where would I get 200 to 400 buyers? Professionals use databases of buyers that total over 100,000 optimal buyers. So it's not as hard to find a pool of 200 to 400 buyers that are interested in at least learning about the deal. The next step of the broker process is to negotiate the deal. Well, that's actually the next step of the professional process, but in the industry, we use a different term, limited auction. Now, this is not about auctioning off your business. It's not like an eBay auction or an art auction. The only reason it's even called an auction is because buyers like I used to be submit written bids. But other than that, it's nothing like you would think of in an auto auction. Here's how the auction in the professional process is different than an eBay auction. First of all, none of the buyers will know who any of the other buyers are, and will not know what any of the bids are. This is all done by mail, and you won't disclose anything. After you sell your company, you'll almost certainly disclose whom you sold it to, so I'll ultimately learn one of the buyers that I was competing with, but you won't even announce what they paid you, so I'll never know how my deal stacked up. If I win your auction, I don't have to buy your company. If I win your auction, you don't have to sell your company. And in fact, if I win your auction, at that point, we know I'm your buyer, but we don't know what I'll be paying you because we'll continue to negotiate from there. So just think of the limited auction as a way to go from 200 to 400 buyers down to one buyer. The last step of the broker process is to get paid. Well, it'd be pretty bad if that wasn't the last step of the professional process. But notice I use a different term, wire transfer. One of the problems with the broker process, it's not just that we tend to get the small stack of dollars, and most companies are sold that way, but worse than that, we get 25% of the small stack of dollars in cash and 75% in bad forms of payment. There are ways to get paid that are better than cash. There are plenty of ways to get paid that are worse than cash. Some of the bad ways can even be converted to good ways. So it's not as simple as getting paid in cash, but how we get paid is at least as important as how much we get paid. The reason following the correct process is critical is that value is dramatically different between one process and the other. All right, so we have our first poll question. Do you have an exit plan? And Lori's going to put the poll open. We've got three different answers. It's in writing, it's in my head, or I don't have a plan like that. So everyone, please select an answer. And here in a few seconds, be honest, this is true confessions. In a second here, we'll have our poll results. Give everyone just another second. I'm guessing the poll results should be in by now. And so I'm going to go ahead and proceed. I don't see them, so I'll just assume that here they are. All right, so 57% of us said we don't have one. 11%, good for you, said it's in writing. Now 32%, I have one, but it's in my head. I have to tell you, a strategy without a written plan, it's just a wish. And so we've really got to make sure that we have a plan in writing. Many of us have a plan for growing our business, but we may not have a plan for exiting our business, and that's important. And so to start our plan, we need to understand things from the buyer's point of view. The famous business guru, Peter Drucker, made a lot of the rules by which we as professional buyers always lived our lives. When I was first trained as a buyer, a lot of Druckerisms were pounded into my head. Well, one of the most important ones is that the buyer rarely buys what the seller thinks he is selling. The buyer rarely buys what the seller thinks he's selling. So what does this mean? And what is it really then that the buyer is buying? If you're selling an HVAC contracting business, you might assume that the buyer is buying an HVAC contracting business. But you have to realize, if you're selling a middle market business, that's a business typically defined as 0 to 500 million in annual sales, but especially if you're selling a lower middle market business, a lower middle market business is a business doing $0 to $25 million in annual sales. You have to understand that the optimal buyer is not buying your business for what you were able to do with it. I'm buying it for what I can convince my board we can do with it in the future with our resources. Well, every buyer has different resources, strategies, synergies, channels, core competencies. Every buyer will project a different value with a business or for a given business than every other buyer would project. If somebody's doing $2 million in sales and they lose half of their sales down to 1 million, they might feel they've lost half of the value of their business. And if they're doing 2 million in sales and they double their sales to 4 million, they might believe that they have doubled the value of their business. And if you were selling that business to another entrepreneur who has no additional resources, there would be some truth to that. Not as much as you think, but some truth. But if you were selling that business to an optimal buyer, and I have the resources to grow it to 30 million, whether it's doing 1, 2, or 4 million on the day that I buy it is almost irrelevant. And if your platform's unchanged, my future's unchanged, it's completely irrelevant. And in a moment, I'll talk about what that platform is. But first, let's talk about multiples. They're also called sometimes formulas. Most of the people on this call, I'm fairly certain, have heard of multiples or formulas. They're quoted by accountants, lawyers, trade association. A formula, or almost, I can't say every single industry, but virtually every industry uses multiples or formulas. Things like 3 to 5 times your EBITDA or some multiple of your profit. Why is it that buyers in every industry use this? It's because they're trying to set low expectations in the seller's mind. Think about every multiple, like let's say a buyer says in this industry we pay 4 times your profit or 4 times your EBITDA. That's based on the seller's past, but no buyer would ever calculate value on it that way. If I said to my board, I wanted to pay the seller some multiple of some number on his bogus financial statements, they'd have laughed at me. They'd have said, Dave, why don't you pay him the square root of his social security number? As dumb as that is, that's not much dumber than taking the seller's ginned up financial statements, applying some facts to them, and somehow that's the value of the business to us. The only thing my board ever cared about is a pro forma financial statement. I imagine most of you know what that is, but in case you don't, a pro forma is a forward-looking financial statement. It shows the future of our business if we have purchased the seller's business. Well, the formulas and multiples that we've all heard of, they're all based on the past. And they're based on the seller's past, not the buyer's past. And for that matter, they're not based on the seller's past. They're based on a legally crafted fantasy, legally crafted by you and your accountant to convince the IRS that you're incompetent running your business. People will say to me, oh, Dave, my accountant prepares my financial statements. Really? I've owned a lot of businesses in my life. My accountant never prepared my financial statements. Someone in my shop always took the first cut of my financial statements. Now, what I paid my accountant to do was to destroy my financial statements. We never crossed the line, but I wanted to make it look so bad that the IRS would realize I was incompetent running my business. And so you make your financial statements look so bad that if you showed your P&L to your best friend, he'd say, gosh, Joe, you're still a young man. You could earn a living. You could make something of yourself. Abandon this dream of being an entrepreneur and get an honest job. Well, you wanted your financial statements to look that bad, but if you now present your business to a buyer, and I've purchased 305 companies in my career, I can assure you, I figured out 300 companies ago. The value of the business is not in the financial statements. If you sell your business, whatever number you sell it, you could then take that amount of money and you could divide it into your profit or your revenue. It would be some sort of number. All right, well, Generational Group, I'm thinking of a couple of recent deals. They sold a contract. They sold, 70% of a contractor, and the purchase price that the seller got in cash from the buyer, if you divided it by the company's revenue, by its sales, it equaled 2 times the company's sales. Actually, that was a trucking company. The contractor example I was going to give, the selling price, once again in cash, equaled 3 times the company's highest ever revenue. Does anybody believe that the formula that they use in the contracting industry is 3 times the sales? Of course not. Well, why did those deals sell for those numbers? It's because that's what the businesses were worth. Formulas are designed by buyers to set low expectations in the seller's mind. And they really, if you think about it, they make no sense. For example, I've seen plenty of deals where Generational sold a company that was losing a lot of money, and it sold for millions of dollars. If a multiple or a formula worked, then that would mean that if a business is losing money, the seller should have paid the buyer to take it off his hands, not the other way around. And so if multiples and formulas are not the answer, and we already determined, Drucker said, the buyer rarely buys what the seller thinks he's selling, then what is the buyer buying? The buyer is buying the opportunity to grow his earnings in the future by acquiring your business. Now, how can I grow my earnings by buying your business? There's, under the umbrella of return on investment, there's only 3 possible ways that I can do that. Either your business can grow under my ownership with my resources, or there's a synergy between your business and other assets that I already own, or it's the intangible assets. The intangible assets are the assets that are not on your company's balance sheet. I gave you some examples here of intangible assets. Let's actually talk about some real-world concepts here. I'm going to use some common examples. For this first one, actually, let me use an actual deal. This is a company Generational sold 2 years ago. It was a third-generation publisher of phone books that was losing a ton of money and was located in Newton, Iowa. Now, if you think about it, would it be easier to sell your business or sell this business I'm describing to you? I mean, if you would say it would be easier to sell the phone book company, I'd have to ask, how stupid is your business? I mean, you ask my grown kids about phone books, they think it's something that's on their phone. They don't realize the internet used to be printed and delivered to everybody's house. And so, you know, why would a phone book, by the way, there was a robust auction for this business, and it sold for a high price. Now, the top bidders were all advertising companies, so they were buyers from the seller's own industry. You'll learn in the second half of this, in the next webinar, we'll talk about the biggest mistake business owners make. By far, the biggest mistake is they only present the business to buyers that are already in their industry. And so in this case, it was more or less buyers in their industry, but it wasn't old school printed advertising. It was new age digital advertising companies, and those were the top bidders. Well, what were they bidding on? Well, first of all, the answer is on the screen. But what is the answer? When I ask people this question, the most common thing I'll hear is that they were interested in the customer list or the database or the technology or the name and reputation, which we'll talk about in a moment. But none of those are the right answer. Although every buyer was bidding on different things, the top bidders were focused on one thing above all else. They were focused on the trained staff. In fact, they were focused on one particular group of staff members, which was the sales force. This company happened to have a sales force trained to sell advertising over the phone, and they were very good at it. Obviously, it didn't matter that they were located in Newton, Iowa, and it didn't matter that they were selling the wrong type of advertising. Think about how hard it is to find one good sales rep. And this company had an entire trained sales force that was ready to go. So here's my question for you. If that had been your business, you're the third generation owner, losing your money, wishing grandpa had been a farmer like everyone else's grandpa in Iowa, would you have figured out that the sales force was the critical driver of value? I doubt you would have. But here's the point. The deal makers didn't figure it out either, and they don't have to. All you and your deal makers have to do is realize the values in the intangible assets, and then you present those to the buyers, and the buyers will each decide separately which intangible assets are of interest to them and what they're worth. When you talk about your customers, not as buyers of your product or your service, but as channels of distribution. Now you're using the words that buyers use. Not in the phone book example, but in most deals, the most important critical intangible asset tends to be the reputation of the business. Think about why this is. If you're selling an engineering company, whose name should go on that engineering business after I buy it? My name? A private equity group from the UK who thinks an engineer is the guy running the train? Or your name, a guy who's been providing engineering services in your state for the last 20 years? It's your name and reputation and my resources that would allow me to produce the future. And so this begs the question, if name and reputation tend to be the most important intangible asset, how long does it take to lose a 20-year reputation? Well, the answer, some people will tell you, is 1 minute. But if I ask you, how long does it take to get a 20-year reputation, you probably think the answer is 20 years. It's not. The answer is 9 to 14 months, because I'm going to buy it from you. But I'm not going to tell you that's what I'm buying. I'm going to tell you I'm buying your trucks and your equipment. But think about that for a moment. Do you actually believe that if I want to buy a bunch of broken down trucks, the best way to do it would be to buy your business? That would be the most ridiculously expensive way to buy a bunch of used equipment. And so what the seller should realize is that all the buyer is buying is the opportunity to produce the future using his or her resources and your intangible asset. To really understand this, you have to look at what's happened over time. This is a 4-decade study that was published by Ocean Tomo regarding the value of a privately held business. And so you'll notice that in 1975, they took all of the money that buyers had spent buying companies and they calculated the value of the hard assets that those buyers got in those acquisitions. They determined that 83% of the money that had been spent that year buying companies was justified. It was covered by the hard assets that those buyers received. Well, then how did the buyers get their boards to pony up the other 17% of the purchase price? It was goodwill. If you've ever heard the term goodwill and you weren't sure what it meant, in terms of mergers and acquisitions, goodwill is the value of your intangible assets. Well, notice what happened over the 4 decades of the study. The numbers inverted to where in 2015, only 16% of the money spent buying businesses was based on the hard assets. The reason for this shift was we shifted to a service economy where most of the businesses buyers are buying don't even have any hard assets. All right, so when we talk about value, you have to be clear that as a buyer, I am very happy. If I'm using other people's money, if I'm using my corporation's money, I'd be happy to pay you the full value of your business. But if you don't know what you're doing or you don't know the value of your company, not only will I steal it from you, I'll sleep like a baby tonight because it's not my job to protect your interests. And so let's look at how I would typically start negotiations with any business owner. Let's say that the last few years, your revenue and profits have been flat. This is a graph of revenue and profits over time. And let's say that you're projecting, or I'm projecting, that they'll be flat for this year when I'm buying the business. If you're like most sellers, you'll give me all the reasons why you're entitled to be paid for that green line. And if you try to pitch me on the green line, as a buyer, I'll give you all the reasons why the best I could possibly do is to pay you for the red line. But in reality, nothing on this page has anything to do with the value of your business. It's about negotiating the selling price, but not the value. So how is the value of a business truly calculated? What is the way that professional dealmakers do it? And what is the way that professional buyers do it? Let's take a break for our next poll question. And so I'm going to ask now, have you had a business value document prepared? And Lori's posting the options now. You can answer that you haven't had one, or you can answer that you have, and you can even tell us who prepared it. Did an accountant, a broker, an investment banker, a wealth manager, etc. We'll give everybody just a couple seconds to complete their answers. And we'll see what the answers say. As soon as Lori sees we've got enough, we'll put them up there. Here we go. We had 19% prepared by an accountant. Now, I have to tell you, while accountants are very good at calculating the value of a business, what they're calculating is really accounting value. Getting an accountant to be comfortable selling the future of a business can be very difficult. Here was the answer from an M&A professional, which is some sort of investment bank, which I would say is good, but let me hinge on that for. Well, actually, let me talk about it. Of the first 4 answers, having a value done by a professional, somebody like Generational, while that is going to be the most accurate number, we'll see in a moment it's still not necessarily going to be the selling price of the business, because the way each buyer will calculate value is differently. Those of us who've had no valuation document prepared, the main reason that would concern me is if we're not thinking about value long before we're ready to exit. If you're going to exit in 10 years, and that's when you start thinking about value, you won't have done any of the things that you should have done over the previous years to build the value. What sellers need to understand is they need to sell their company the same way buyers buy it, which is they sell the past, they explain the past, but then they sell the future. Let me show you what I'm talking about, and let's look at some examples. Take a look at Company B, for example. Now, this is a live transaction, a real deal. Company B was doing $430,000 in profits and $300,000 in net worth. Generational sold that business for $5.6 million. How did the buyer get his board to even allow him to pay $5.6 million? It certainly was by promising $430,000 worth of profits. That wouldn't even get you a 10% return on investment. And so step one, buyers always recast the past. And recasting, you'll see in a moment, comes in two different flavors. And recasting is about rewriting the history of your company to get rid of things or to adjust things that would not be good indicators of my future. Let's go back to that graph that I showed you a few minutes ago. And you'll notice now I've added free cash flow or after-tax profit is not the same thing as free cash flow, but it's close enough for our purposes today. That's the vertical axis. But on the horizontal axis, you have time. This is the way buyers would present your company to their board to get them to authorize the highest possible purchase price that they can get authorized. They go backwards 5 years, 3 years. They go forwards 5 years. But the current year is not part of either period. So if I was buying your company during calendar year 2019, 2019 is not part of the 3-year past because it hasn't ended yet, and it's not part of the 5-year future because we're still in 2019. Before I calculate value, I'm going to recast your P&L. The P&L recast, your accountant may have referred to this as add-backs, is where I remove from your P&L all the things that you added in to tank your company's performance. This is where I take out one guy's company car as a Cessna. Another business owner had a pontoon boat as his company car. I've seen plenty of businesses where they had 7 family members that had company paid cell phones, but only one of them did any work at the company. Mary is paying herself a salary of $280,000 a year. If I buy Mary's business and she's willing to stay with me, I can pay her $280,000 a year. But after she leaves, will I pay her replacement $280,000 a year? Of course not. And Sam, his business owns a corporate retreat. It's actually a hunting lodge, but on the documents they call it a corporate retreat. And since they do, I naturally say to Sam, all right, since it's called a corporate retreat, do all the employees get to go? Sam says, well, the other employees don't even know we have a corporate retreat. Only I know we have a corporate retreat. And so let's say that the P&L recast raised your historic starting point to $250,000. Notice what it says at the bottom. Your mileage will vary. I'm just trying to show you from examples. I mean, there's plenty of deals that have worked like this, but there's plenty that have been greater or smaller. I'm just trying to illustrate how things work. The P&L recast, some of you had already heard of. What most of you probably have not heard of is the M&A recast. At first glance, you might think this is just a bigger version of the P&L recast, but they're completely different. Under the M&A recast, I'm actually rewriting your company's history as if I owned the target business all along. What are some things? You had an uninsured fire loss last year. Buyers have fires. We never have an uninsured fire loss. Anything that I wouldn't have done, like spending a bunch of money on a 10-year strategic plan, the reason I wouldn't have done that is I already have a 10-year strategic plan. Things that won't happen again, anything that's not reproducible. We don't have time to get into details on it, but buyers will always reprice the input costs of any target business that they're looking at. And so the M&A recast can have a bigger effect many times than the P&L recast. Let's say in this example, it raised the past to $500,000. Whatever number it raises it to, $300,000, $800,000, whatever the number is, buyers consider that to be your historic past recasted, and then from that point is where we project our future. Let's say that as a buyer, I assumed I could grow at a 10% compound annual growth rate. That means in year one, I'll do $550,000, year two, $605,000, and so on and so forth, so that 5 years from now, I'm projecting I will have grown your business to $805,000. That's a combination of recasting and growing the business forward. Keep in mind, we'll talk about different types of buyers in the April 26th webcast that might have projected a completely different future for that business. Now that I know what I believe I can do with this business, how do I determine how much I can pay you for that? In other words, what is the value to me as a buyer? We all know money has a time value. And so if I'm certain I'll do $805,000 5 years from now, I'm not going to pay you $805,000 today for that fifth year of future free cash flow. I have to discount it using a discounted cash flow table, which you can find in the back of any finance textbook. Let's say that between the time value of money and the risk that I assign to this deal, I need a 20% return on investment. Well, then I just take those 5 discount factors for years 1, 2, 3, 4, and 5 out of the table, and I plug them into a calculation. And so I take the 5 years that I'm projecting forward for your business, and as you can see, I've inserted the numbers that I believe I'll do in the next 5 years with your business. That totals to $3.4 million. But as we said, I can't pay you $3.4 million today because I believe I'll get $3.4 million over the next 5 years. It's worth a lot less than that. But how much less? If I need a 20% return on investment, I insert those present value factors from the previous table, and I multiply across. So to get the present value of year one, I take $550,000, multiply it times 0.833, that equals $458,000. I take each year and I multiply it across based on the discount factor, and I find that the $3.4 million that I'm hoping I can produce in the first 5 years, that's worth $1.9 million cash in closing today. Now that's not the value of your business. That's the value of your 5-year pro forma. If all I did was pay you for the 5-year pro forma, I'd be renting your business. I wouldn't be buying it. And so buyers calculate for value on a forever basis by using residual value or terminal value. And almost everyone uses something called the Gordon growth model. The Gordon growth model says, since it's almost impossible to predict year 5, and it's considered impossible to predict beyond year 5, we just assume that year 5 continues forever, that it doesn't go up and it doesn't go down. And so I'll do $805,000 a year every year to infinity. Not only is that a reasonable approach, it makes the math dead simple. To calculate the value of a stream of earnings of $805,000 a year, that starts today and goes on through infinity, all you have to do is divide by the 20% discount rate. And so that stream of $805,000 per year would be worth $4 million cash at closing today if it started today. But it's not going to start today. It'll start 5 years from now. So the Gordon growth model says divide it by the year 5 discount factor. And so the value of your business from year 6 to infinity with this set of assumptions is $1.6 million. The value of the first 5 years of the pro forma is $1.9 million. And so the enterprise value for this particular buyer at this particular point is $3.6 million. We have to remember that every buyer will have different recasts, especially the M&A recast. Every buyer will project different growth rates, and every buyer will use a different discount rate based on their perception of risk. And so value could be, one buyer might calculate $1 million, $2 million, another might calculate 4 or 5. This particular buyer calculated $3.6 million. This is why we actually have to go through limited auction to determine the true value. All right, before I wrap, let me ask one more poll question. And this is about, do you remember a firm called Jawbone? They used to make Bluetooth headsets. If you remember a firm called Jawbone that used to make Bluetooth headsets, hit the first radio button. If you think you might have heard of it, sounds familiar, and if you've never heard of them, mark the last choice. And I'll tell you why I'm asking this in a moment, but let me see the answers first. All right, let's go ahead and look at the poll results. Oh, wow, 72% remember it, and almost everybody thinks they might remember it. All right, so let me tell you why I asked this question. 3 years ago, Jawbone was valued at $3.2 billion, and a few months ago, they went out of business. Follow me on this. A guy gets an offer for his business of $3.2 billion, and he ends up getting nothing 3 years later. I mention that because this will cover, in our April 26th webinar, we'll cover this and many other reasons why just calculating value isn't the answer. We also have to know all of the factors that drive value. All right, Bill, I'm going to throw it back to you. We've got 15 minutes left. I know that there were some questions submitted in advance, and I assume you may have gotten other questions, so I'll throw it to you to pick the questions. Bill, are you there? Okay.
Bill, are you there? I think you're muted.
Right. Maybe we lost Bill.
Maybe he's dialing back in.
All right. Well, I think, do you happen to have any of those questions that were submitted, Lori, in front of you? Because I'd have to open up a whole bunch of things on my computer to find them. I know that while you're looking for them, let me mention one question, because one question that was asked, I actually prepared a chart for, because someone had asked about an ESOP, an employee stock ownership plan. So while we're trying to find either Bill or the questions, let me jump to the question that this gentleman was asking, how is value determined in an ESOP? And if you don't know what an ESOP is, under U.S. law decades ago, they established the ESOP concept, which was designed so that employees could be owners of businesses. And the way an ESOP typically works is that a bank will lend the money to your company. Your company will then pay the money to you over time. It's not paid right away. It's paid over time, although you do get to defer taxes for a while. And then that money, so now you as the owner, now you're getting the money over time, you give your shares back to the company. The company then gives those shares over time to employees. Hopefully the employees will pay for them using some sort of payroll deduction, and then that money will be used to retire the bank loan. There was a time when this first came out in the 70s and 80s where we as deal makers thought ESOPs were somehow better than selling to employees. And by 1992, as an industry, we had created 16,000 ESOPs. And ever since then, we've been unraveling ESOPs because it turned out they had huge problems. One of the problems was the owner had to guarantee the bank loan. And so frequently, the owner wasn't really selling his company at all. Also, always the owner in an ESOP has to show his employees all of his financial statements before they do the ESOP. And then if the employees decide not to do the ESOP, you can't unring that bell. And so for the most part, other than maybe some accountants who have been supporting ESOPs because they want to, I guess, get the fees to produce them, we've been as an industry, we've been unraveling 5 ESOPs for every new one that's created. But recently there's been a huge change in this, which changes everything. You know, under the ESOP program, normally the bank determines the selling price of the business, and they typically will do it using some sort of a multiple or a formula, like 3 times your profit or 4 times your profit. Could you possibly think of anybody less qualified to determine the value of your business than your banker? And so ESOPs were really a problem, but recently there's been a huge development. Private equity groups, which we'll talk about in the next webinar, have been so anxious to differentiate themselves that they have been offering what are called PE-backed ESOPs. This is where the private equity group actually replaces the bank. And this changes everything because the private equity group can compete with the other buyers in a limited auction, and you can compare the ESOP to other bidders. And so hopefully that answers that question about ESOPs. I now see that we've got Bill, are you there?
Yeah, Dave, can you hear me okay now?
I hear you just fine.
I apologize for the technical problem. Dave, we have one question. We have several in here, and I want to remind listeners you can input your questions on the toolbar at the right. Dave, here's a question for you. What is the biggest mistake that companies make in calculating the value of their business, and why?
Well, obviously, if you haven't seen this presentation, which we all have, the biggest mistake people would make is they assume the value of their business is in their financial statements. And so if the guy is doing $300,000 in pre-tax profit, he's assuming that's what he's selling. In other words, my future is $300,000 in pre-tax profit. Well, the reason that's obviously a massive mistake is because if you follow the professional process that we just went through, you're going to be selling to me, and more importantly, the buyer's going to be calculating the future of the business under his ownership with his resource. And of course, that's a completely different number.
Makes sense. Dave, one other question we have here is, when is it time to have a professional business valuation performed? And a second part to that question is, how does a business owner determine who to engage for performing business valuation?
If I'm going to go to market quickly, like in this next 12 months, I would hire an investment banker, and Generational or one of those other companies. I would hire an investment banker, and I would have them do the valuation. But I would also, more importantly, I would have them take it to market, because ultimately the number that anybody writes on a page, an investment banker or anything else, the one that like investment banker is the most realistic, but it's still not necessarily what the business will sell for. It's going to be based on, what are the bidders going to buy. Now, if I was going to determine value today because I wanted to sell in 10 years and I wanted to make changes to the business to increase value, then I would have, that's the main time that I would go out and have a valuation performed. And obviously, I'm biased toward investment bankers because they're going to calculate value based on recast in the past, but also based on projecting the future, based on what the buyers could do with it in the future and who are the likely buyers. And of course, people like Generational will look at comparable sales and things like that. So that's who I would hire, but more importantly, when I would hire somebody to do that.
Thank you. Here's a question that's just come in. How do you deal with debt that is owed for shared expenses to a parent company in the sale. And the listener asked that you use that as a "I wouldn't do that if I ran it" scenario.
Okay, I'm going to, hopefully I understand the question. If you say that the debt that is owed to a parent company, now of course, if the seller owns the subsidiary company and the same business owners own the parent company, then it's really a transfer debt. It's a debt between common organizations, and so it can be placed on the balance sheet of the subsidiary company. When you sell the subsidiary, it can be promoted up to the balance sheet of the parent company. Either way, if I could buy your business for $5 million cash, and as part of that deal, I would absorb your $1 million bank loan, which is typically what I would do, and typically what you want. Well, that would mean if you had not had the $1 million bank loan, I could have paid you $6 million for the business. So the short answer is it comes out of the seller's end of the transaction. Now, the longer answer is from the standpoint of the of whose name is the debt in. If the bank loan or whatever debt was made to the company, even if the sellers personally guaranteed it, it's generally not personally taxable to the sellers when that is wiped out. So in a long way around, the IRS will end up absorbing some of that deal. On the other hand, if it was a personal loan to the seller, not to the business, then it would be, it would just be as I indicated. And as far as I wouldn't do that if I ran a scenario, the main thing you want to watch out for is obviously if you sell to an optimal buyer, they're going to absorb. There's actually two ways they can either absorb the loan or they can pay it off. If they pay it off, that's not a problem. They pay it off at the closing table. But a lot of times, due to the structure of the deal, the buyers will absorb the loan, which is fine. But now there's one more step. Your deal maker has to go to your banker, which deal makers do all the time. The deal maker has to go to the banker, after the letter of intent is signed, and he has to say, look, my client has signed a letter of intent to sell his business to this big corporation. I need a written release from you now, Mr. Banker, that says once you have the buyer on the hook for this, you'll release my client from his personal guarantee, which, of course, the bank is going to do in a second because they'll say, I'd rather have the big buyer on the hook than the small seller. But if you did not get that release, in the unlikely event that the buyer went bankrupt, or the much more likely event that the business unit that the buyer created to buy the business went bankrupt, they could come back to you. So that's I wouldn't do that if I ran a scenario. Go ahead, Bill.
Yeah, one final question, Dave, and that is, how do we work in some of the metrics you talked about, recasting your earnings and recasting your valuation, and tie that into a long-term incentive program such as phantom stock or performance units with that change of business value over time as a measure of success?
Now, the way I read this question, normally when you talk about phantom stock, you're talking about, it's not actually legal stock, but it's given to employees first of all, it makes them feel like they're owners, and it will give them some participation in the profits of the business. So in some ways, it works like ownership. And of course, with performance units, et cetera, you could be talking about the same thing. We have things in the industry like stay bonuses and items like that. If you're saying that I want to tie the incentive compensation of my employees to the value of the business, there's a few issues you have to consider here, and I know we're tight on time. But first of all, confidentiality is issue number one. As a general rule, the biggest mistake people make in mergers and acquisitions by far is telling their employees they're thinking about selling the company. Because when that happens, employees panic, they jump on the jobs, they don't realize that they might be better off under the new owners and certainly not worse off. And so the very idea of tying performance to business valuation is very risky, because now you're implying that you're going to tell them you're thinking about selling the business. But if I was going to do that, I would get a professional valuation done, And then I would say to the employees, all right, here's where we are now. I'll sell someday in the very distant future, but I want to reward you annually or every 5 years, whatever, for improving the value of the business. And I would determine metrics as far as probably what I would say is to myself, where do I want to be 10 years from now? And then I break that up into smaller units, and I would incent my employees with what I would give them is stock that vests over time. So they get the stock when they deliver the full performance, but they don't actually own the stock until it vests. If, on the other hand, I was going to keep things confidential for my employees, which I would definitely recommend, then instead of tying it to business value, I would tie it to metrics that could yield better business value. In other words, when Generational does a deal, they produce something called the Roadmap for Enhancing Value and what's called Deal GPA, which grades a business on an A to F scale for 36 different components. And so if I have some components where I got a D or an F, what that means is the buyer will ding me heavily for value if those things are still as they are when I go to sell years from now, that I would set those as the performance metrics for my employees, not based on value, but based on, look, these are things that have to be fixed. We have no Instagram presence, and I'm just making that one up, but we have no, and so I would set goals based on the items that I got dinged on in my Deal GPA report card from Generational.
Dave Heymann, thanks so much. A wonderful presentation today and very, very interesting information. Thanks for joining us today.
Thanks, Bill.
And for those of you listening, thank you for attending today's webinar. And as Dave mentioned, we have part 2 on April 26th, What Factors Maximize Business Value. Please join us for that. And between now and then, we also have 2 webinars focused on talent management. On April 5th, the new recruiting paradigm, how to get smarter, faster, and more strategic. And on April 12th, 7 common HR mistakes and how to avoid them. So please join us for those webinars and register for any of our webinars at vistage.com/FWV. That's FWV as in Fridays with Vistage. On behalf of Vistage Worldwide, this is Bill Black wishing you continued success, and this concludes today's webinar.